Hello, welcome to this training where we will cover common qualified plan errors and suggested correction methods. These are going to be errors that are most common that we encounter when we do benefit plan audits here at our firm. So we'll go over common plan errors and corrections, the key takeaways, and a few resources. So the first most common is late or missing employee deferrals. So employee elective deferrals were not timely deposited in the plan. Reminder that the Department of Labor's definition of timely deposited is as soon as the assets can be reasonably segregated from the plan sponsor's assets. So timely means something different to every plan based on the facts and circumstances for that plan. So the best way to prevent this error is to coordinate with your payroll preparer to determine the earliest date you can reasonably segregate the deferral deposits from general plan sponsor assets, and then set up procedures to ensure that you make deposits by that date. Another recommendation here is don't do it early. If you have a process and a specific date, say 3 days after payroll, and then you end up doing it 2 days after payroll for one of the payroll runs, then that becomes your new earliest date. So make sure that you're consistent and always do it as of the date that your procedures dictate. Suggested correction method here, you can deposit the late deferrals plus interest. Again, what does that look like through the self-correction? You can calculate actual or reasonable earnings, file Form 5330, and pay the 15% excise tax on interest. Using the Department of Labor Voluntary Correction Program, you can submit the application to the Department of Labor for a no action letter. You use the DOL lost earnings calculator. You may get relief from the excise tax if you give employees proper notice, and the excise tax, any excise tax under $100 can be contributed to the plan. Next are hardship distribution errors. So we're looking at hardship distributions that weren't made properly. Either was a hardship distribution approved when the plan doesn't allow for hardship distributions, or potentially was the hardship distribution approved when there wasn't a true hardship, that the reason didn't truly meet one of the safe harbors that a hardship distribution can be approved for. So how to prevent? Be sure that you're reviewing all in-service distributions and determine whether hardship distributions met the plan requirements, and also maintain proper documentation. As a side note, Secure 2.0 allows employees to self-certify hardship events, amount, and no other means of accessing funds. This is an optional provision of Secure 2.0 if the plan sponsor elects the self-certification option. Then you need to make sure that there is documentation of the fact that the participant needs to either fill out a form and sign it, or some other paper trail needs to be kept of that self-certification option. If that option is not elected by the plan, the pre-Secure 2.0 documentation rules apply, and that the employer, the plan sponsor, is responsible to document what the hardship event is, what the amount is, and that the participant has no other means of accessing funds. So keep that in mind. That's an optional provision for self-certification. So a suggested correction method is, this would be an operational failure corrected by plan amendment. You need to match the plan document to the actual operation. So say you allowed for a hardship distribution, but the plan document doesn't allow for them. That's where this correction method kind of lines up. And any plan amendment must satisfy Section 401A. And the participant should restore the distribution to the plan plus earnings is the second option. If you're not going to amend the plan document to reflect what's actually happening, then this is your other option, is that participant needs to restore the distribution to the plan plus earnings. Okay, eligibility error. So what we see here a lot is an eligible employee is not is excluded from the plan or not allowed to enter the plan at the correct time. Or also we see it on the flip side where there potentially could be an ineligible employee that was allowed to enter the plan and make contributions. So some ways to prevent this: make sure that you're reviewing the plan document sections regarding eligibility and participation, and that there's regular training for those plan administrators and people who are determining when employees are entering the plan. That could be a payroll manager, but make sure that the plan document, we understand the sections on eligibility and participation, and those who are determining when employees are entering the plan understand that. A few suggested correction methods here. There's a missed deferral opportunity amount that depends on the type of plan and the HC highly compensated and non-highly compensated status of the participant. So just reminder there, it does depend on the type of plan for that missed deferral opportunity correction. You must fund any employer contribution associated with the actual missed deferral opportunity. And also, terminated employees are not eligible for the reduced QNEC in this correction method. Okay, incorrect definition of compensation. So the plan's definition of compensation is applied incorrectly. So how to prevent: make sure that you perform annual reviews of compensation definitions from the plan document, and ensure that the person in charge of determining plan compensation for payroll purposes is properly trained to understand that plan document and adoption agreement. So, is there a new pay code that was added this year? And when that was set up, did we make sure that that pay code, does it meet the definition of compensation from the plan document, and as such, it should be part of compensation when determining contributions to the 401k plan. Suggested correction method here: this is an operational failure corrected by plan amendment. Make sure you match the plan document to the actual operation and make sure it's permitted under code corrections. And then you could do a corrective contribution based on excluded compensation plus lost earnings. If you're not looking to amend the plan, you should do this corrective contribution based on excluded compensation plus lost earnings. Okay, loan administration error. So if the plan allows for loans not being administered properly, what this might look like is, say that the loan program from the plan document and the loan program only allows for 2 outstanding loans at any point in time for each participant, but potentially a participant is allowed to take out a 3rd loan. That would be a loan administration error. So how to prevent: make sure that all loans that are outstanding follow the plan provisions and maintain proper documentation for each loan. Another example of an error on loan administration that's kind of common is if the plan document requires that there is approval from the spouse before the plan loan is taken out. If that spouse approval wasn't obtained, that would be a loan administration error. So some suggested correction methods for loan administration errors: if there's deemed loans beyond the max payment period, meaning, there's no more time for the employee to either pay off the loan, or be able to pay the loan through payroll deductions because it's beyond that date, there needs to be a 1099-R in the year of correction. Deemed loans within the max payment period, meaning that it was appropriately treated as a deemed distribution. You need to accrue interest. You need to do a single sum payment to bring the loan current, or re-amortize the balance over the remaining schedule or max period. It could be a combination of the above. And just a reminder that post Secure 2.0, there is an option to correct certain loan administration errors under the self-correction program. Auto deferral and auto escalation errors. So, we're talking about that people didn't get set up with auto deferral when they were eligible to enter the plan, or the other potential issue is that there is an auto escalation schedule saying that the participants' deferral percentage increases by a certain percentage amount up to a max, but the auto escalation doesn't happen according to that schedule. So how to prevent this error? Make sure that you establish processes and controls to ensure that auto deferrals and auto escalations follow plan provisions and regulatory requirements. The suggested correction method here is that the plan sponsor must fund any employer contribution associated with the actual missed deferral opportunity amount. And reminder, Secure 2.0 permits no QNEC application to terminated employees effective 2024 for plan year 2024. Plan governance and oversight. One of the common ones we see is there's no committee or board meetings held for whoever is charged with governance over the plan, or there's meetings of the committee or the board, but no minutes of the meetings are kept. So pretty straightforward on how to prevent. Make sure that those charged with plan governance meet at least annually and minutes are kept of all meetings. Some suggested correction methods for this plan governance and oversight error. Start the practice as soon as possible. And when you are keeping those minutes, some important things to make sure that you're documenting in those minutes. This is kind of a minimum, what should be in those meeting minutes. Decisions for discretionary employer contribution amounts, if there are going to be any discretionary employer contributions, or if there are not going to be for the plan year, that decision should be documented either way. When you are looking at benchmarking investment performance or the associated fees for the investments within the plan, that should be documented in the minutes that that's being done. That is a due diligence requirement for plan fiduciaries to be doing on a regular basis. You want to document that you're doing that regularly. And then details on plan provision changes. For example, have you decided to elect the safe harbor match for the plan year? That should be something that's documented in those meeting minutes. Another plan governance and oversight error that we see is there is no ERISA fidelity bond in place, or that the bond amount that's in place is inadequate. So how to ensure that an appropriate ERISA fidelity bond is in place for the plan as of the first day of the plan year. So suggested correction methods here. Put the bond in place immediately. Make sure that the correct bond amount is determined and updated as needed annually. There is a formula to follow. It's a prescribed formula that the DOL requires on what the bond amount should be. It's either a minimum of $1,000 up to a maximum, and if it's in between those, based on plan assets, it's a certain percentage of plan assets. Ensure that the bond is placed with a surety or reinsured that is named on the Department of Treasury's listing of approved sureties, and these are listed in the Department Circular 570. Sometimes plan sponsors, plan administrators will get confused and think that officers' errors and omissions insurance will cover this ERISA fidelity bond requirement. It does not. This coverage is unique coverage. It needs to explicitly state that it is covering the ERISA fidelity bond requirements. Sometimes maybe the insurance company can have a rider that is with your business liability insurance policy, but sometimes they don't write this coverage, and you need to make sure that you have someone that is named on that listing. So some key takeaways and resources for compliance here. Preventing common errors at the end of the day can look like regular audits, both internal and external, staff training for your plan administrator, for your HR director, for your payroll manager. Anyone that's involved in the day-to-day plan operations needs to have regular training. Also, automation anywhere possible. Automation can reduce errors for deferrals, match calculations, and eligibility. Utilizing correction programs properly. There's a lot of options out there, especially now with the new self-correction program rules brought about by Secure 2.0. So employers should use the correction, either the EPCR system or the VFCP programs for timely and accurate error remediation. As soon as you identify the error, you should make sure that you initiate correction. work with a plan compliance specialist or an ERISA attorney to make sure that you do the correction correctly. Establishing some compliance strategies. One of the great ones that we recommend is a compliance calendar. So you have key dates on when certain things need to happen, be it plan amendment requirements, participant required communications, plan notices. If you know the plan is going to make a change, what are the communication requirements with the participants? Does that need to be done a certain number of days in advance? Things of that nature can be added to a compliance calendar. Again, automating processes wherever possible. Integration with the payroll system and the HRIS system, or the payroll system and the record keeping system can always be a great option for automation. And then clear human resources and payroll communication are essential strategies when you've got human resources managing some functions of the plan and payroll managing some functions or operations of the plan. Communication between the departments and individuals is also essential. One resource that is a really great resource because I do feel like it is well worded to make it easily understandable is the IRS does put out a 401k plan fix-it guide for some of these common errors. There's actually the 12 most common mistakes that the IRS sees. So there's tips on finding, fixing, and avoiding the 12 most common mistakes. And there is the website for that resource, that IRS 401k plan fix-it guide. Thank you for joining us for this training today. We hope that you find this information helpful, and I hope you have a great day.